Welcome back to the channel. In today's video, we're discussing a critical yet often overlooked factor in investing success: your personal risk tolerance. Risk tolerance refers to how much investment risk and volatility you are comfortable taking on as you work towards your financial goals. Understanding your unique level of risk tolerance is essential for making investment decisions that are aligned with your needs. What exactly do we mean by investment risk? At its core, risk refers to the possibility of permanently losing some or all of your original capital, or of experiencing short-term losses and periods of negative returns. All investments carry varying degrees of risk. Even conservative options like bonds face default risk, while stocks are inherently more volatile than fixed income. There are a few key types of risk to be aware of. Market risk: the risk that markets as a whole may decline, affecting the prices of all securities. This systemic risk cannot be avoided by diversifying. Inflation risk: the risk that inflation will exceed any returns from an investment, eroding its purchasing power over time. Business financial risk: the risk associated with a specific company or industry that may cause the price of those investments to fluctuate more than the overall market. Interest rate risk: the risk that changes in interest rates may negatively impact the value of bonds or fixed income funds. Currency risk: for international stocks or bonds, fluctuations in foreign exchange rates introduce additional variability. So in summary, all investments carry the risk of short-term drops, but some, like individual stocks, are far more volatile than others, like bonds or guaranteed products. The trade-off is that higher-risk assets also tend to provide higher potential long-term returns if held through market cycles. Let's go through some reasons why analyzing your risk tolerance is important. Importance of risk tolerance includes: 1. Guiding investment choices. Your risk tolerance serves as a guiding force behind the investment decisions you make. Understanding your tolerance level helps in selecting assets and investment vehicles that align with your comfort zone. This prevents making rash decisions based on market fluctuations. 2. Balancing risk and return. It acts as a balancing scale between risk and return. Individuals with higher risk tolerance might aim for higher returns, accepting the volatility that accompanies it, while those with lower tolerance might prefer more stable, conservative investments. 3. Stress management. Knowing your risk tolerance reduces stress when market conditions fluctuate. It prevents panic-driven actions that might harm your portfolio during volatile periods, allowing for a more disciplined approach to investing. 4. Long-term planning. Risk tolerance plays a crucial role in long-term financial planning. It influences retirement planning, portfolio diversification, and goal setting, ensuring that your investments align with your financial aspirations without causing unnecessary stress or anxiety. 5. Psychological comfort. It provides a sense of psychological comfort, allowing you to invest in a way that feels right for you. This psychological alignment with your investments can foster confidence and discipline in sticking to your financial plans. This deeper exploration delves into how risk tolerance impacts various aspects of investment decisions, from portfolio construction to emotional well-being. This is where properly assessing your risk tolerance level becomes so important. Some key questions to ask yourself include: how long is your investment time horizon? The longer your time frame, the better able you are to ride out short-term volatility in pursuit of returns. What would a 10–20% short-term drop in the value of your portfolio do to your emotions? High-risk investors stay calm during downturns. When will you need to begin withdrawing money from your investments? Near-term goals require lower-risk assets to avoid selling at inopportune times. How well would you handle the stress of large short-term losses? Conservative investors prioritize minimizing drawdowns over maximizing returns. Are you investing money you may need to access in an emergency? Only invest funds in higher-risk assets that you don't foresee needing for 5+ years. By honestly reflecting on questions like these, you can determine if you have the stomach to stay invested during turbulent periods or need a more conservative approach. And that self-awareness is critical to make investment decisions that match your personal risk tolerance rather than chasing returns. Now that we understand the importance of risk tolerance, let's go over some steps you can take to implementing risk tolerance. Step 1. Self-assessment. Begin by conducting a thorough self-assessment. Analyze your financial goals, time horizon and personal comfort with market fluctuations. Tools like risk tolerance questionnaires or assessments can provide insights into your risk capacity. Step 2. Diversification strategy. Tailor your investment portfolio to match your risk tolerance. For instance, if you have a higher tolerance for risk, you might opt for a more aggressive portfolio with a larger allocation to stocks. Conversely, lower risk tolerance might steer you towards a more conservative allocation, emphasizing bonds or stable assets. Step 3. Regular reviews and adjustments. Periodically review and recalibrate your portfolio in line with any changes in your risk tolerance. Life circumstances, financial goals, or market conditions can influence your risk appetite. Ensure your investments reflect your current risk tolerance levels. Step 4. Education and professional guidance. Educate yourself on investment risks and potential returns associated with different asset classes. Seek advice from financial advisors who can help align your investment strategy with your risk profile. Step 5. Staying committed and disciplined. Once you've established your risk tolerance and crafted your portfolio accordingly, stay committed to your plan. Avoid making impulsive decisions based on short-term market movements. Maintain a disciplined approach even during turbulent times. Understanding your risk tolerance is not just about numbers. It's about aligning your investments with your comfort level. It's an ongoing journey rather than a one-time assessment. By acknowledging your risk tolerance and applying it thoughtfully to your investment decisions, you've taken a crucial step towards financial empowerment. Remember, risk tolerance isn't static. It evolves over time. Continuously reassessing your risk appetite as your life circumstances change is key to maintaining a well-suited investment strategy. Stay informed, disciplined, and open to adjustments, allowing your portfolio to adapt in sync with your risk comfort. Ultimately, embracing risk tolerance isn't about eliminating risk entirely. It's about finding the optimal balance between risk and reward that aligns with your financial aspirations and emotional comfort.